Well, stocks are up as the economy adds 223,000 jobs in June. That's largely in line with the 230,000 jobs economists were looking for. Here to talk about what this means for the markets and the Federal Reserve's looming rate hike is Steve Blitz, the chief economist at ITG. And Steve, the headline number wasn't so bad, but average hourly earnings were only up 2% over the past year and flat during the month.
Right, and that's essentially, people are taking this into inflation, people getting wages or not. This is basically a reflection of the mix of who's getting hired. 55% of the increase was in what we would call low-paying jobs at retail, temp, health, and restaurants. And these are lower-paying jobs. And these, interestingly, the growth in these jobs really throughout the recovery really reflects the economy that we have, which is that you have a lot of people who have income to spend on leisure time, and so you're seeing a lot of increase in employment in those areas, and as the baby boom ages, there's an increased need for health care. Now, interestingly, when you look at the wages within those sectors, they're actually accelerating. So you're actually seeing good wage growth in retail, in health, in restaurants. So it's not that the wages aren't growing, it's just that when you look at the average, it just reflects the fact that lower wage jobs are growing much faster than higher wage jobs. But finance jobs did increase last month, and that's a higher wage sector, so that's a good thing.
So we're seeing some pockets of growth there, but the unemployment rate did dip to 5.3% in June from 5.5% in May, suggesting that people are giving up looking for work. So how can we see higher wages if that's going on?
Well, on a month-to-month basis, those types of numbers can be a little skewed by seasonal factors. I think you have to look at that over an extended period of time. And the extended period of time story is simply that as baby boomers age out of the workforce, the labor participation rate is falling. Interestingly, there was a time when the labor participation rate was rising that it was actually viewed as a sign of weakness in the economy, that you now needed two wage earners in a family in order to support yourselves. But now that it's falling, it's viewed as a weakness as well. So I think when the story is written on labor participation rates over long cycles, which is beyond what we're talking about now, which is month to month, I think the jury's a little out about how meaningful it really is.
Yeah, and what does all this mean for the Fed's rate hike? I mean, is September still the base case? One jobs report shouldn't throw too much of a wrench into the Fed's plans.
No, I mean, look, the numbers that we got were, and with the downward revision, right, puts us at around 240,000 for the last 2 months. The economy has slowed. In the first 6 months of the year, we added about 204,000 jobs. Last year, for the first 6 months, we added about 235,000 jobs, on a monthly basis. It's slower than last year, but it's still supportive of at least 2.5% real growth. And we're only talking about a move in the funds rate from 12 to 25 basis points. I think the Fed, through its verbiage, has just created a mountain out of a molehill of a move. And it's really just a small move.
But September is still your base case?
September's the base case. Look, you have 2.5% real growth. Some people say you got 3% in the second quarter, fine, but it's still 1.5% of the first half of the year.
And just real quick, sectors that we should be watching amid higher rates, should I be buying financials and maybe staying away from utilities and telecoms?
Well, what you're saying is just stay away from bonds. And, obviously at these low levels of rates that, that's sort of the way you want to go. But I like, rather than make a comment about the bond market per se, I think that you can say that financials are a good buy here, I think in general. And I think some consumer stocks are. And I still like the home builder sector, because even though the growth rate of employment in the 25 to 34-year-olds has slowed a little bit, it's still up year-over-year basis enough to suggest that we should continue to get some good home selling going.
All right, Steve Blitz from ITG, thanks very much for coming in.
Thank you.
I'm Scott Gamm, and you're watching The Street.